Here's a question most people never ask out loud. If you had $40,000 sitting in a bank account right now, would you be better off buying shares in a real estate investment trust or using it as a down payment on an actual rental property? By the end of this 15-minute breakdown, you'll know exactly how to run the numbers on both options, what the real costs and taxes look like, and most importantly, which strategy actually makes sense for your situation. No hype, no get-rich-quick promises. Just the math. I want to tell you about two people I know. Let's call them Sarah and Mike. Both in their early 30s, both making around $85,000 a year, both trying to build wealth through real estate. Sarah bought $10,000 worth of REIT shares through her brokerage account. She spent about 20 minutes researching, clicked buy, and went back to her day job. Mike saved up $40,000 for a down payment, spent 3 months searching for a rental property, dealt with inspections and mortgage paperwork, and finally closed on a $200,000 condo. 5 years later, Sarah's made around $3,000 in dividends and her shares are worth about $13,500. She spent maybe 2 hours total managing the investment. Mike collected $90,000 in rent, but after mortgage payments, repairs, property taxes, and one nightmare tenant who punched a hole in the wall, he's cleared about $28,000. He's also spent roughly 15 hours a month dealing with landlord duties. So who won? Well, that's exactly what we're here to figure out. Because the answer isn't simple, and it completely depends on what you're willing to trade. We're in a unique moment for real estate investing. REITs finished 2024 up about 5%, but they were volatile, dropping over 8% in the fourth quarter alone as interest rates stayed stubbornly high. Meanwhile, the rental property market has been caught in a squeeze. Mortgage rates that started 2025 above 7% have recently dropped to around 6.2%, the lowest in over a year. Home prices are still elevated but starting to soften in some markets. For anyone sitting on capital right now, trying to decide between liquid REIT exposure and direct property ownership, the stakes are real. We're not in the 3% mortgage era anymore. Every decision you make about real estate investing today happens against a backdrop of higher borrowing costs, shifting Fed policy, and an affordability crisis that's fundamentally changed how Americans build wealth through real estate. So let's break down exactly how each option works, what you'll actually earn, and what it'll cost you. What it is, in plain language. A real estate investment trust, REIT, is a company that pools money from investors to buy and manage income-producing properties, apartment buildings, shopping centers, office towers, warehouses, data centers. By law, REITs must pay out at least 90% of their taxable income as dividends to shareholders. You buy shares just like you'd buy stock in Apple or Microsoft, and you earn money two ways: through quarterly dividend payments and through appreciation if the share price goes up. Direct rental property means you own residential or commercial real estate that you rent to tenants. You finance it with a mortgage, collect monthly rent, handle maintenance and repairs, and potentially profit when you sell. Here are the 5 essentials. 1. REITs give you fractional ownership in a diversified portfolio of properties. A rental property puts all your capital into a single asset. 2. REITs are liquid. You can sell shares in seconds during market hours. Rental properties can take months to sell, and you'll pay significant transaction costs. 3. REITs pay dividends that are taxed as ordinary income. Rental properties give you income that's offset by deductions for mortgage interest, depreciation, repairs and operating expenses. 4. With REITs, you have zero control over management decisions. With rental property, you control everything, for better or worse. 5. REITs require minimal time. Rental properties require ongoing attention, or you pay someone 8 to 10% of collected rent to manage it for you. How it works, a step-by-step. REITs. First, you open a brokerage account, Fidelity, Schwab, Vanguard, whatever you prefer. Second, you search for either individual REITs or a REIT ETF, which gives you exposure to dozens or hundreds of properties through a single purchase. Third, you place your order, it's filled in seconds. Fourth, every quarter, dividends hit your brokerage account automatically. Fifth, you monitor performance and decide whether to reinvest dividends or take the cash. That's it. Rental property. First, you save for a down payment, typically 20% of the purchase price for an investment property. On a $200,000 property, that's $40,000. Second, you get pre-approved for a mortgage. With rates currently around 6.2%, a $160,000 loan will run you about $980 a month in principal and interest. Third, you find a property, negotiate, and go through inspections. Fourth, you close. That means signing a mountain of paperwork and paying closing costs, usually 2 to 5% of the purchase price. Fifth, you find tenants, collect rent, and handle repairs when the water heater breaks at 11 p.m. Sixth, you pay property taxes, insurance, WA fees, and maintain an emergency fund for major repairs. Seventh, if and when you sell, you pay realtor fees, typically 5 to 6%, and capital gains taxes on your profit. How people build wealth with this, strategies and important decision rules. REIT strategies. Strategy 1. Buy and hold for passive income. Investors purchase REIT ETFs in their brokerage accounts and reinvest dividends automatically. This works best for people who want real estate exposure without the hassle, and who have other investments covering their growth objectives. Decision rule. Use this when you value time and liquidity over maximizing returns. Strategy 2. Sector rotation. More active investors shift between different REIT types, data centers, healthcare facilities, industrial warehouses, based on economic trends. For instance, data center REITs were up 25% in 2024, while industrial REITs dropped 18%. Decision rule. Only do this if you're willing to research and actively monitor commercial real estate fundamentals. Strategy 3. Portfolio completion. Institutional investors use REITs to quickly gain exposure to property types they don't own directly, like cell towers or specialized healthcare facilities. Decision rule. Use this when you already own some real estate and want broader diversification without the capital requirements of buying another property. Rental property strategies. Strategy 1. Buy and hold for cash flow. Purchase a property below market value, rent it out, and collect monthly income that exceeds your mortgage and expenses. This is the classic landlord model. Decision rule. Only pursue this if you have stable income to cover vacancies, a cash cushion for repairs, at least $10,000, and either time to self-manage or budget for professional management. Strategy 2. House hacking. Buy a duplex or multi-unit property, live in one unit, rent out the others to offset your mortgage. This reduces your living expenses while building equity. Decision rule. This works when you're willing to live adjacent to your tenants and want to minimize out-of-pocket housing costs while building long-term equity. Strategy 3. Value-add investing. Purchase a property that needs cosmetic updates, make improvements, then rent at higher rates or sell for profit. Decision rule. Only do this if you have construction knowledge, reliable contractors, and enough capital to cover both the purchase and renovation costs without leveraging yourself dangerously. Strategy 4. Delayed gratification with REITs. Some investors start with REITs for immediate diversification while saving up the larger down payment required for rental property. Decision rule. Use this when you want real estate exposure now but need 2 to 5 years to accumulate the capital and knowledge for direct ownership. Who this is best for, profiles for each. REITs are best for Profile 1. Busy professionals with limited free time who want real estate exposure without becoming landlords. You value liquidity and have capital you might need to access within 3 to 5 years. Profile 2. Investors in high tax brackets who already max out tax-advantaged accounts and want additional diversification. Note that REIT dividends are taxed as ordinary income, but you're not chasing tax advantages, you're chasing convenience and diversification. Profile 3. People building wealth steadily with smaller capital amounts. Anywhere from a few thousand to $50,000. You can dollar cost average into REITs monthly without waiting to save a full down payment. Profile 4. Those who want exposure to commercial real estate sectors you couldn't access directly, data centers, cell towers, healthcare facilities, industrial warehouses. These require multi-million-dollar investments to own directly. Rental property is best for Profile 1. Individuals with at least $50,000 liquid, for down payment plus emergency reserves, stable income to cover potential vacancies, and either time to manage the property or willingness to pay for management. Profile 2. People who enjoy, or at least tolerate, hands-on involvement. You're comfortable screening tenants, coordinating repairs, and handling the occasional 2 a.m. emergency call. Profile 3. Those seeking maximum tax advantages through depreciation, mortgage interest deductions, and the ability to defer capital gains through 1031 exchanges. You're in a position where tax optimization matters significantly to your wealth building strategy. Profile 4. Investors with long time horizons, at least 7 to 10 years. You can weather market cycles, periods of vacancy, and the illiquidity of real estate without needing to access your capital. Profile 5. Those who want leverage to amplify returns. With 20% down, you control an asset worth 5 times your initial investment, and you benefit from appreciation on the full property value, not just your down payment. Let's run real numbers, using current market conditions as of late 2025. Base case. REIT. You invest $40,000 in a diversified REIT ETF with an annual yield of 4.5%. That's conservative. Some REITs yield more, but let's be realistic. Year 1. You receive $1,800 in dividends. 40,000 times 0.045. Now, taxes. REIT dividends are taxed as ordinary income. If you're in the 12% federal bracket, you paid $216 in taxes. If you're in the 22% bracket, you paid $396. If you're in the 32% bracket, you pay $576. Let's use the 22% bracket since that covers household income from about $47,000 to $100,000 for single filers, and up to $190,000 for married couples filing jointly. After tax dividend, $1,800 minus $396 equals $1,404. Additionally, let's assume modest appreciation of 3% on the share price over the year. Your shares are now worth $41,200. Total first-year return: $1,404 in dividends plus $1,200 in unrealized gains equals $2,604 on your $40,000 investment. That's a 6.5% total return. Important note: you didn't spend any time beyond the initial purchase. You received these dividends automatically. And if you needed your money back, you could sell these shares in under a minute. Base case. Rental property. You buy a $200,000 condo, put $40,000 down, 20%, and finance $160,000 at 6.2% for 30 years. Monthly mortgage payment, principal and interest, about $980. Monthly property taxes, $210. Varies widely by location, using $2,500 per year. Monthly insurance, $125, $1,500 per year. Monthly WA fees, $150, if applicable. Total fixed monthly costs, $1,465. You rent it for $1,800 per month. That's $21,600 annually. But wait, we're not done with expenses. Annual repairs and maintenance, $2,000. 1% of property value is a standard estimate. Annual vacancy allowance, $900. Assume 1 month vacant every 2 years. Annual capital expenditures reserve, roof, HVAC, major systems, $1,000. Your total annual costs, $1,465 times 12, plus $2,000 plus $900 plus $1,000 equals $21,480. Your gross rent, $21,600. Your total costs, $21,480. Net cash flow before taxes, $120. Yes, you read that right. In this scenario, you're basically breaking even on cash flow in year 1. Now let's talk taxes. Of your $980 monthly mortgage payment, roughly $820 is interest in the first year. That's about $9,840 in deductible mortgage interest. You can also depreciate the property, not including land, over 27.5 years. If the building is worth $160,000, that's $5,818 in annual depreciation. Your taxable rental income, $21,600, rent, minus $9,840, mortgage interest, minus $2,500, property tax, minus $1,500, insurance, minus $1,800, WA fees, minus $2,000, repairs, minus $900, vacancy, minus $1,000, capex, minus $5,818, Depreciation equals negative $3,758. You actually show a loss on paper, which can offset other income, subject to passive activity loss limitations, which I'll skip for simplicity. But here's what's happening. You're building equity. Every month, about $160 of your mortgage payment goes to principal. That's $1,920 in forced savings. Plus, if the property appreciates 3% over the year, that's $6,000 in equity gain. Total first-year benefit: $120, cash flow, plus $1,920, equity from principal, plus $6,000, appreciation, equals $8,040. Your return on the $40,000 down payment: $8,040 divided by 40,000 equals 20.1%. That looks amazing compared to the REIT's 6.5%, right? But hold on, let's account for your time. If you spent 10 hours total screening tenants, coordinating a repair, and handling administrative tasks, and you value your time at even $50 per hour, that's $500 in opportunity cost. Subtract that from your $8,040, and you're at $7,540, or 18.9%. Still better than the REIT. But now consider, your $40,000 is completely illiquid. You can't access it without selling the property, which means realtor commissions, closing costs, and months of waiting. Risk, edge case. What can go wrong? REITs edge case. Let's say the commercial real estate market tanks. It's 2026, and office REITs drop 15% due to continued remote work trends. Your $40,000 investment is now worth $34,000. Your dividends also get cut from $1,800 to $1,200 because properties are struggling with vacancies. You lost $6,000 in value, earned $1,200 in dividends, taxed at $264 in the 22% bracket. So after tax dividends of $936. Net result: minus $5,064 or minus 12.7% return. The mitigation: REITs are diversified. If you own a broad REIT ETF, one sector's collapse is balanced by others. Data centers and healthcare might be thriving while office properties struggle. Also, you can sell immediately and reallocate to better performing sectors. Rental property edge case. Your tenant stops paying rent in month 6. You start eviction proceedings, which take 3 months and cost $2,500 in legal fees. The tenant trashes the place on the way out. $5,000 in repairs. Month-by-month breakdown. Months 1 to 5. Collect $9,000 in rent. Spend $7,325 in costs. Net $1,675. Months 6 to 8. No rent, but you still pay mortgage, taxes, insurance, $4,395. Month 9. Eviction complete, repairs needed, property vacant. Month 10 to 11. Making repairs, $5,000 total. Month 12. New tenant found, collect $1,800. Total income for the year: $10,800. Total expenses: $21,480, normal, plus $2,500, legal, plus $5,000, repairs, equals $28,980. Net: minus $18,180. Your equity gain from principal paydown: $1,920. Your appreciation: $6,000, assuming property still appreciates despite the disaster. Total: $1,920 plus $6,000 minus $18,180 equals minus $10,260. That's a minus 25.6% return on your $40,000 investment in year 1. The mitigation: screen tenants rigorously, credit checks, references, employment verification. Maintain a larger cash reserve, at least $15,000. Consider landlord insurance that covers lost rent and legal fees. Or pay for professional property management to handle tenant issues proactively. The sensitivity analysis: you have to know about interest rates. Let's see what happens if mortgage rates drop to 5.5%, optimistic scenario, or rise to 7%, pessimistic scenario, while REIT yields stay relatively stable. At 5.5% mortgage rate, monthly payment drops to $908 versus $980 at 6.2%. You save $72 per month, or $864 annually. Your net cash flow improves to $984, 120 plus 864. Your total first-year return, 984 plus 1,920 plus 6,000 equals $8,904 on $40,000 equals 22.3%. At 7% mortgage rate, monthly payment jumps to $1,064. You lose $84 per month, or $1,008 annually. Your net cash flow becomes minus $888. Your total first-year return, minus 888 plus 1,920 plus 6,000 equals $7,032 on $40,000 equals 17.6%. The sensitivity is real. A 1.5 percentage point swing in mortgage rates changes your return by nearly 5 percentage points. Meanwhile, if REIT yields shift from 4.5% to 5.5% due to rising rates and REIT yields often move together. Your dividend income increases from $1,800 to $2,200, improving your after-tax return from $1,404 to $1,716, an extra $312, or less than 1% of your investment. REITs are more stable. Rental properties are more sensitive to financing costs. When to avoid and the biggest pitfalls. Avoid REITs if you're seeking maximum tax advantages. REIT dividends are taxed as ordinary income. You don't get the qualified dividend rate that makes stocks more tax efficient. If tax optimization is your primary goal, direct property ownership offers far more deductions. You want control. REIT management makes all decisions. You have zero input on which properties they buy, when they sell, or how they manage operations. You're chasing short-term gains. REITs can be volatile. In Q4 2024, REITs dropped over 8% despite being up for the year. If you can't stomach that kind of swing or if you need the money within 2 to 3 years, REITs might not be appropriate. You're avoiding diversification. Some investors buy a single REIT focused on one property type, like shopping malls or office buildings. That's essentially sector betting. It's high risk. If that sector struggles, you have no buffer. Avoid rental property if you don't have at least $50,000 liquid. You need the down payment plus an emergency fund. Without reserves, one major repair or period of vacancy will financially devastate you. You lack the time or temperament for active management. Being a landlord means dealing with people, problems and paperwork. If that sounds miserable, you'll resent the investment, make poor decisions, or pay someone else 8 to 10% of rent to do it for you, which crushes your returns. You can't handle illiquidity. If there's any chance you'll need that capital back within 5 years, direct property ownership is too risky. Selling takes months, costs 6 to 8% in transaction fees, and might force you to sell in a down market. You're in a market where properties don't cash flow. In many high-cost areas, rental income doesn't cover expenses. Investors in those markets are betting purely on appreciation. That's speculation, not investing. If the numbers don't work from day one, walk away. Biggest pitfalls for both. Pitfall 1. Over-leveraging. Don't stretch to buy the biggest property you can qualify for. Leave room for error. Pitfall 2. Ignoring fees. REIT expense ratios, typically 0.1 to 1%. And rental property management fees, 8 to 10%, compound over time. Always ask what you're really paying. Pitfall 3. Chasing recent performance. Data center REITs crushed it in 2024. That doesn't mean they'll crush it in 2025. Last year's winners are often next year's losers. Pitfall 4. Assuming appreciation. Real estate does not always go up. Some markets are flat or declining. Buy based on cash flow, not on hopes of appreciation. Pitfall 5. Underestimating behavioral challenges. It's hard to watch your REIT drop 15% and not panic sell. It's hard to deal with a nightmare tenant and not want to quit. Behavior, not math, determines most investment outcomes. Let's go over taxes and costs. REIT taxes. Dividends are taxed as ordinary income at your marginal rate, 12%, 22%, 24%, 32%, 35% or 37% depending on your income. However, you may qualify for the 20% qualified business income deduction on a portion of REIT dividends, which effectively reduces your tax rate. For example, in the 22% bracket, a 20% deduction lowers your effective rate to about 17.6% on that portion. Capital gains when you sell are taxed at long-term rates, 0%, 15% or 20%. If you held for over a year. REIT costs. Expense ratios for REIT ETFs. 0.1% to 0.5% annually for broad index funds. Up to 1% for actively managed funds. Brokerage transaction fees. Usually 0 for stock and ETF trades at major brokers. No ongoing maintenance or management costs. Rental property taxes. Rental income is taxed as ordinary income, but you can deduct mortgage interest, property taxes, insurance, repairs and maintenance, property management fees, depreciation, 1/27.5 of the building value annually. If you show a loss on paper due to depreciation, even while cash flowing positively, you may be able to offset other income if you qualify as a real estate professional or if your losses are under $25,000 and your income is under $100,000, subject to phase-outs. When you sell, you'll pay capital gains taxes on your profit. But if your adjusted gross income is under certain thresholds, you might pay 0% on long-term capital gains. Plus, you can defer taxes entirely by doing a 1031 exchange into another investment property. Rental property costs. Down payment. 20% is standard for investment properties. Closing costs. 2 to 5% of purchase price. Property management. 8 to 10% of collected rent, if you hire someone. Maintenance. Budget 1 to 2% of property value annually. Capital expenditures, roof, HVAC, appliances, budget 1% annually or set aside funds for big-ticket items every 10 to 15 years. Vacancy. Budget at least 5 to 10% of potential rent. Transaction costs when selling. Realtor commissions, 5 to 6%, plus seller closing costs, 1 to 3%. Simple rule of thumb. REITs cost you almost nothing to own and maintain. Rental properties have ongoing costs that average 35 to 50% of gross rent when you include everything. Here's a 7-step action plan you can use right now for each one of these strategies. For REITs, open a brokerage account if you don't have one. Fidelity, Schwab and Vanguard are all solid choices. This takes about 15 minutes. Determine how much you want to invest. Don't use money you'll need within 2 years. Research broad-based REIT ETFs. Look at expense ratios, lower is better, historical performance, and diversification. Examples include VNQ, Vanguard Real Estate ETF, or SCHH, Schwab US REIT ETF. Decide between lump sum investing or dollar cost averaging, investing a fixed amount monthly. For most people, DCA reduces timing risk. Place your order through your brokerage. Choose reinvest dividends if you're focused on long-term growth. Set a calendar reminder to review performance quarterly, but don't obsess over daily price movements. Understand your tax situation. REIT dividends will generate 1099 DIV forms. Talk to a CPA if your income is complex or if you have questions about the qualified business income deduction. For rental property, get pre-approved for a mortgage. This shows you what you can actually afford and makes you a serious buyer. Expect to provide tax returns, pay stubs and bank statements. Save your down payment, 20% of the purchase price. PLUS an additional $10,000 to $15,000 for emergencies. Research markets. Look for areas with strong job growth, population growth and rent-to-price ratios that make sense. Use sites like Zillow, Redfin and local property management companies to understand rental rates. Run the numbers on every property before you make an offer. Calculate gross rent, subtract mortgage, taxes, insurance, estimated repairs, management fees and vacancy. If it doesn't cash flow on paper, walk away. Work with a real estate agent who specializes in investment properties. They understand the numbers and can help you avoid emotional purchases. Get a thorough inspection before closing. Budget $400 to $600 for this. Negotiate repairs or price reductions based on what's found. Line up a property management company or develop a system for tenant screening, rent collection and maintenance coordination. Do not wing this part. Let's recap everything a bit. So back to our opening question. If you have $40,000 sitting in a bank account, should you buy REIT shares or rental property? Here's the insight most people miss. These aren't actually competing options. They're complementary tools for different jobs. REITs are a liquidity tool. They give you real estate exposure without locking up your capital or your time. They're appropriate when you want diversification, when you're early in your wealth building journey, or when you value optionality over maximum returns. Rental property is a leverage and tax optimization tool. It lets you control a $200,000 asset with $40,000, benefit from depreciation and interest deductions, and potentially generate superior long-term returns. If you're willing to accept illiquidity, management burden and concentration risk, the sophisticated approach isn't REIT versus rental property. It's REIT plus rental property. Start with REITs for immediate diversification. Build knowledge, build capital, build systems. Then, when you're ready, when you have $50,000 liquid, when you understand the math, when you can handle a tenant emergency without panicking, add direct property ownership to amplify your returns. The people who build serious wealth through real estate aren't the ones who make binary choices. They're the ones who understand the trade-offs, match the tools to their situation, and play a long game with multiple strategies working in parallel. Now let's go over some frequently asked questions. Q. Can I lose money on REITs? Yes. REITs dropped over 8% in Q4 2024. They're traded securities subject to market volatility. However, over long time horizons, 20, 30, 50 years, REITs have historically outperformed the S&P 500. Q. What if my rental property sits vacant for months? You still owe the mortgage, property taxes, insurance and WA fees. This is why you must maintain a cash reserve of at least $10,000 to $15,000. Never buy a rental property if you're financially stretched. Q. Are REIT dividends guaranteed? No. They fluctuate based on the trust's rental income and property values. During recessions or sector downturns, dividends can be cut. However, by law, REITs must distribute 90% of taxable income, so they tend to be more stable dividend payers than regular corporations. Q. Can I buy REITs in a retirement account? Yes, and it's often smart to do so. Since REIT dividends are taxed as ordinary income, holding them in a Roth IRA or traditional IRA can shield you from annual taxes. You won't pay taxes on dividends as they're paid, and in a Roth, you won't pay taxes on gains when you withdraw in retirement. Q. How do I know if a rental property will cash flow before I buy? Use the 1% rule as a rough screen. Monthly rent should equal at least 1% of the purchase price. For a $200,000 property, you want $2,000 per month in rent. Then do detailed math. Subtract mortgage, taxes, insurance, repairs, management and vacancy. If you're not netting at least $200 to $300 per month after everything, the deal doesn't work. Q. Should I pay off my rental property mortgage early? Probably not. If your mortgage rate is 6.2% and you're in the 22% tax bracket, your effective after-tax cost is about 4.8%. If you can earn 7 to 10% in the stock market or through other investments, you're better off investing extra cash there. Plus, the mortgage is leverage that amplifies your returns on the property's appreciation. Q. Are there REITs that don't invest in residential or commercial buildings? Yes. There are specialty REITs that own data centers, cell towers, timberland, farmland, storage facilities, healthcare properties, even billboards. This is one of the advantages of REITs. You get exposure to real estate sectors you could never afford to buy directly. Q. What's the biggest mistake first-time rental property investors make? Underestimating expenses. People calculate mortgage, taxes and insurance, then assume the rest is profit. They forget repairs, capital expenditures, vacancy, management fees and the value of their own time. Always use conservative estimates. Budget 40 to 50% of gross rent for all expenses, and if you beat that, great. If not, you're covered. Disclaimer. This content is for educational purposes only and is not financial, investment, tax or legal advice. Your individual situation is unique. Consult qualified professionals before making investment decisions. Real estate investing involves risk, including loss of capital.